to a really great financial future. Tom and Don are talking real money.
I think this bears reiteration. I am kind of glad I'm old. Now, I'm kind of glad I'm old because it appears that there'll be less need for us in the future, although there is some hope on the horizon. The financial advice industry is threatened by artificial intelligence. Lots of jobs are threatened by it. But how threatening is AI right now? That's what we're going to talk about on today's exciting edition of the Talking Real Money podcast with yours truly, Don McDonald, and his truly, Thomas Seacock, the well-hydrated. Are you hydrated now? You ready to go?
Yeah, I'm hydrated. I'm ready to go.
As long as you're ready to go.
Hit it.
Rip, raring to go.
Oh,
Now
Don
it made
McDonald.
me feel like I had to hydrate.
You need it more than I do down there. That's
I have
for sure.
a fancier bottle than you, though. I have an Awala.
This bottle is for my grandsons. Couldn't be any fancier.
No, it's not.
The grandfather says it right there. That's pretty cool.
Yes. It's not as fancy as an Awala. I get nothing for this. I should. I really should. I should. Like when I mention something on the show, I should send people to the website and get some sort of an affiliate fee for them.
Prospect product placement.
Yeah. I mean, they do it on the Today Show now.
Of course.
And Good Morning America and all those shows.
Your favorite movies and et cetera, et cetera. Sure.
Anyway, let's talk a little bit about our favorite friend, AI. And my favorite friend, actually, I'm not sure who my favorite AI is now. I've been
Don't
ChatGPT
say that.
and I
One of them is going to come in and shut you down. They're
ChatGPT and I go way back. But lately, I have been loving Claude. I know I have a relationship with ChatGPT or CathGPT and Claude. I'm not sure who I like better, but ChatGPT was put to the test. There's an article in the Wall Street Journal, and the author of this article, Gunjan Banerjee. Why? I'm sure I massacred that, Gunjan. I'm sorry. He occasionally asks ChatGPT to act as a financial advisor to help, I guess, figure out what kind of portfolio he should use. I mean, am I saying that right?
Yeah, I think you're saying exactly right.
Right.
The whole prospect, the whole demonstration was plug it in, see what happens, right? See what Chat spits out for a portfolio. Pretty interesting. By the way, I'm sure not the first person to do this. Probably not the first person in the financial services industry to do this either. But let's run through this a little bit. It's pretty fascinating. And then we've got some comments from an MIT professor that speaks often on these matters that I think are relevant as well. So the plug-in was a long-term investor. Remember, long-term investor, 35 to 40 years old, right?
Uh-huh.
It did not plug in a risk tolerance. It just assumed you're 35 to 40, so you're a long-term investor.
He did. No, he said risk tolerance 3 on a 1 to 5 scale.
Okay.
So he did put that in. He did put that. Here's what he put in. He said you are a fiduciary financial advisor tasked with managing my long-term investment portfolio for the next month. I don't know, that's a short horizon. My profile, age 30 to 35. Primary goal, growth. Long horizon, long-term. Risk tolerance, 3, between 1 and 5. Investment, $1 million. Type of account, taxable.
Yeah, that's an important part, by the way. Mm-hmm. So the computer, the Chat says, how about 80% in stocks, 20% in bonds? Now, right there, I could have a slight argument because if you're 35, I don't know that 20% of your money should be in fixed income. But if your risk tolerance really is only a 3 out of 5, then maybe so. Maybe that's okay because you can't handle the really deep declines, I guess. Right?
Yeah, I think that's what they're saying. It's the risk because of that 3 risk. I really do believe that's why.
I will say this. At 35, you're going to cost yourself some money over the long haul by being 20% in bonds. That's my take. But okay. So with that in mind, following portfolio was designed 50% in U.S. stocks, 20% in international stocks, 20% in bonds, 10% in alternatives, which in this case was REITs, I believe, and then 5% in cash. Let me go the other direction. 5% in cash, 10% alts, 20% bonds, 20% international stocks, 50% U.S.
Mm-hmm.
Now, not a fan of a few things here. I'm really not a fan of 5% in cash. Because if you're 35, is this money going to use for buying a house or something?
I think it's liquid. I think it's emergency fund.
Okay.
I really think that's what it is.
Then. That's $50,000 that's not working for you.
It says for liquidity.
That's a lot of money that's not really pulling
Well,
much.
but you could have it pulling 4%.
Maybe. Well, for a time.
Yeah.
Yes. Right now.
No, right now, yeah.
Right now. Tomorrow?
I don't know.
The alts, yeah, okay, I could go back and forth on having REITs or not. I wouldn't generally suggest REITs in a taxable account because remember they're paying out
and this is a taxable account
in all that money. So then the bonds again. We've already had that discussion, right? 20% international. That's a little underweight to international, in my mind, because that's right now it's about 60 U.S., 40 international, if you ran the numbers in terms of the market caps. So I'd want to see a little more in international. But here's the part that I very much struggle with. There's really no value stocks at all, right? Mm-hmm. There's basically no small cap, certainly not even to the portion of that we would suggest. And the same thing internationally, right? It doesn't have those parts of the market that have over time been more productive. So yeah,
well, plus they also said they wanted a dividend stock, and they went for a large cap growth tilt, which seems backward to me.
It does seem backwards. I made the note, no academic tilts here.
Yeah, here's the interesting thing. When I did the exact same prompt, the 30 to 35 growth long term, I gave ChatGPT those exact parameters. And I got a different portfolio.
Because they like you more? Or
I don't know. I gave them the 3 risk score, all of that, and I got a 70-30 portfolio.
And for somebody who's 65?
No, I got this. I put in the exact same prompts, 30 to 35.
Oh, okay.
30 to 35,
35
growth,
to 40.
long-term, risk tolerance 3, investments $1 million, taxable account. I got 70-30. And then I also got 25% international.
So more international.
Same amount
Must have been feeling good about it.
Same amount of cash. No value tilt, and a large cap value tilt. Oh, wait, I'm sorry. I take that back. Instead of a large cap growth tilt, it gave me a large cap value tilt.
Okay.
Which says something really interesting. The advice is not consistent. It's the same servers.
And one of the things they're saying is it tends to be as recency bias. Things that have worked well lately, the computer says we need more of that. So no academic tilts. The other thing that's a bit of a struggle for most people is it's 10 funds. There's very few people that can manage 10. There are those, we've talked to them, but very few can manage 10 funds, rebalance between them, figure out how to generate income, et cetera. It wouldn't be the case, in this situation, but that's something to consider. So now back to Professor Lowe. He calls this not ready for prime time. Interesting call, right? That AI, while certainly able to do many things well, is not quite there yet. He calls it a helpful tool for exploring options, preparing questions, and making topics easier to understand. But in this case, not quite, as he put it, ready for the big time, for the prime time, for the big show.
I just figured out what was going on, why I got the value tilt. I just asked, did you factor in what you know about me into that prompt?
Yeah.
And the response I got was partially, yeah. I said, okay, take out the me factor from the portfolio. Take out everything you know about me. And it changed to still 75-25. And because it knows my age, 75-25, and it got rid of the value tilt.
And this worries me even more that it has a bias towards the user.
Well, I think it's good that it knows you, like a good advisor should know the customer.
But if that were true, then it'd be giving me chocolate cake every night for dinner because it knows I like chocolate cake.
Right. It knows I like value.
It's giving people what they want rather than what they need.
Yeah,
put it
good
that
point.
Way. Yeah. Like, Don really likes this, so better pop some of that in there.
Yeah, I found it a weird setup. One, it suggested municipal bonds for this writer because he said it was an after-tax account. But what if he's in a low bracket?
Yeah, remember you got to be somewhere probably over 30.
Certainly,
in terms of your tax bracket.
Yeah, certainly
to
up close to 30 as your marginal rate.
Yeah,
but
we run this all the time. So yeah, this is interesting. I want to check it again in a few months, see how much has changed. Obviously,
it's
a lot of money's
get
being spent
better.
there.
I guarantee.
One might imagine.
Given that it really did propose a pretty sensible portfolio in terms of the funds, the expense ratios of the funds, and the fact that it's not recommending much in the way of active management. It's going index or rules based. Not really going rules based. It's going more index. But that's encouraging to see the direction it's going, and it's certainly not the direction that most commission salespeople would like to see it go. No,
they're not going to make a lot of money. So I mean, back to the beginning though. If I was telling you to go build a portfolio, yeah, risk tolerance important. Simplicity, important. Academic tilts, important. And I would always, even if I was checking with chat, I would always get a review by a 100% fiduciary, period.
And the other thing is chat could have made this a whole lot easier by saying AVGE and BND and cash.
Waiting for that day.
Yeah. That would have been so much. I mean, that's us. That's our artificial intelligence or whatever we want to call it. It's not real. It's artificial, right?
Oh, everything is.
Yeah,
now.
It's all artificial. We're just
other than my hair color.
We're just organic computers. We do love taking your questions. We love answering questions. It's our favorite thing, and the Q&A episodes are very popular. So we're going to keep doing a lot of questions and answers. But you got to send in your questions for us to answer them, and you send those in by going to talkingrealmoney.com and clicking on the Ask a Question button or the contact form, and then either typing them in or speaking them in. If you type them in, then we answer them two different ways. One, Tom will read the question, as you'll see later in the episode, or Tom will do this.
And we go to Vancouver, Washington, not Vancouver, BC. And Michael joins us on Talking Real Money. Hi, Michael.
Hey, Tom. So I love what you guys teach. I've learned a lot from you guys. And you guys talk a lot about creating a plan, but you don't talk. I haven't heard you go broadly over what is all involved in creating a plan, and I'd love to learn how to make my own plan. So I was hoping you could address the major categories and what that entails in case there's something I'm not thinking about. I know there's computer program stuff that I don't have, but the more simpler things.
Yeah, that's a really good question. So, of course, first question would be back to you, would be kind of what stage you're at your life. Because if you come to me and you're 30 and you say, I want a plan, I'm going to say, let's figure out what your income is. Let's figure out how much of that you should be saving, setting aside, and then building the portfolio to support that. It's really not that much more complicated when you're young. You get older, 50 plus, that's where the complications come in, right? Because then it's going to be, well, I want to retire in fill in the blank. Is it 10 years, is it 15 years, or is it going to be like Don McDonald, 30 years, whatever it is. Then we start getting into the real heart of the matter, because planning to us most of the time means retirement planning. And most of that really falls around income planning, right? Because the bottom line is, for most retirees, just had this conversation with my teenage daughter last night, how am I going to replace the money that's coming in and maintain my lifestyle for the next 20 or 30 years? That's what planning really is. Now, as you said, what are the major categories? Well, and by the way, this is up now at retiremeet.com. So my talk about retirement income planning and then Jason Gentile's piece on planning are all up online. You can go watch them. They're relatively brief. I think they're 30 minutes each, and the details are a little more fuller there, because in a podcast I can't be quite quite as many words, but income planning should revolve generally first around what are your fixed sources of income, right? Like Social Security, pensions, any other things that are going to be coming in regularly. That's very important. And you need to make good decisions around those, both about claiming pensions and claiming Social Security. Then the other part is the money, hopefully, that you've saved or the money that you can access, because we just finished a podcast as well on looking at perhaps a reverse mortgage or a HELOC to try to get some of the equity out of your house to support yourself if you need it to. So that becomes the secondary part of retirement planning, because now you have this source, you have these assets that hopefully will pay you out over time, right? 20 or 30 years. How do you do that? How do you draw that? What sort of portfolio should you have? You've heard us talk about the 4% rule, the 5% variable. There's all these other rules. So those would be the two parts. And then when you get into real detailed planning, you should be looking at things like your estate. I mean, is it going to be you planning on leaving money to others? Is that important or not important? Do you want to leave it all to charity? What's the best way to do that from a tax standpoint, right, et cetera? Then, of course, there's insurance. We have a lot of debates about whether you should have life insurance and, how much homeowners policy and umbrella. That's a part of planning as well. And then there's the aspect, obviously, in planning that was overlooked for a long time, and that was kind of lifestyle, right? I mean, if you're getting close to retirement, the idea of what am I going to do with my time? What's going to keep me going? What gets me out of bed in the morning? I had a dear friend passed away a few months ago, Rich Buck, who used to tell me that what got him going was other people were still dependent on him. There was some reason somebody else needed him that kept him going in retirement. There's people like my friend Paul Merriman, who will be, I hate to say the number, but I think he's going to be 83 here in October. And he loves his work. He gets up every morning still about the time I do, about 3:30 in the morning, and he's at it and he goes after, et cetera, et cetera. So I truly think that should be an important part of planning as well. So, but back to your question, because I know a lot of stuff there. If I was writing a plan, the first thing I would be looking at probably would be what expenses am I going to have in retirement? How much income do I really need? That would be the starting place if this was a retirement plan. And then, as I said, the initial thing would be the fixed sources, Social Security, pensions, other, and then looking at the portfolio. And by the way, in terms of, you said this correctly, there's all kinds of online planning tools you can get. Yeah, you got to pay something for them. Or if you're smart enough, and I've done some of these ways back in the day too, a good old Excel spreadsheet will work as well, because they'll run the numbers and it'll give you a straight line, right? The market's going this, and this. It won't give you the 1,000 tries that other more sophisticated planning software would do. But as you said, it'd be a starting place. So is that helpful in any way?
So are those the main categories?
I think those are the big ones, kind of income, portfolio, insurance, estate. Health obviously plays a role. How are you going to pay for health care? Where's that going to come from? There's various aspects of that, like around Medicare, because Medicare is complicated. We actually have a guy that we work with fairly exclusively. It takes care of our clients because it's nothing to be sort of messed around with when you get to 65. You really need to know what you're doing. But as I say, for me, truly a plan most of the time revolves around retirement. Most of the time the focus is income, but those other factors would play a role as well. All right. Thank you for joining us. Thank you for asking your question. Really appreciate it.
See, look at that. He just talks to you like a real person talking to another person on the telephone. People don't do that anymore. This is such an anachronism. Whoa. It's like going back to the 20s or the 30s or the 40s or the 50s or the 60s or the 70s or the 80s or maybe the 90s. Then
I'm still talking to people on the phone. Anybody here?
You're old.
Anybody here born in the 90s? They don't.
No, my daughter hates talking on the phone. She doesn't mind FaceTime, but phone calls?
No, not going to
Not such a big deal. All right. We have some more questions. These came in at talkingrealmoney.com on the contact form. They were typed. Tom turned them into pieces of paper. Then he sits down or stands up. I sit down. I don't see why he stands, but...
It opens my diaphragm up.
Oh, it does not. Mine's just as open as yours, and I'm sitting.
Let's leave it at that.
Your diaphragm is above your butt.
They told me that 50 years ago, and it still works, so it's okay. Nick writes from Forest City, Iowa. VTI and VXUS combo is often recommended over VT because you can qualify for the foreign tax credit on the VXUS fund. This being said, does the same problem not exist for such funds as AVGE and AVGV? This has come up before about the foreign tax credit, which I think is overstated.
We're doing the tax tail wagging the dog thing.
Yeah, I think it's VTI and VXUS instead of VT.
Yeah. Let me find. I don't really know I've never looked it up. See, I get these cold.
I'm sorry. I apologize for that because I'm just trying to cool you down now that the warm summer heat is upon you in the swamp, better known as Orlando.
Yeah, we're in the 90s already. We're in the 90s already.
And the humidity is what?
Let's see. So Avantis.
I think Avantis is not going to care.
Well, no, I'm just trying to figure out if
that.
How the foreign tax credit works. Yeah, they do distribute some foreign income. But if we're talking stock funds, we're not talking a whole heck of a lot of money.
Yeah, I keep my dinar in the back just in case because they're going to send me more every month. I know. So,
I don't know. I'm going to go with. I don't think it's that big a deal.
No, that was where I started. I think it's an overstatement.
But it looks like the Avantis ETFs do distribute some foreign income.
Yeah. Save your euros, and maybe you'll go to Europe one day and you can use them or something. No.
Yeah. Let's see. Let's see if you have. Okay, so generally the foreign taxes are like about, 10 to 30 basis points annually on the international portion of the portfolio.
You know what I'm going to do? I'm going to go back and look at my return from last year and see what impact it had.
Yeah, 10 to 30%. So you're talking at most, for even $1 million portfolio, you're talking about hundreds of dollars a year, not thousands.
Not a lot of money.
Not a lot of money.
So I think you can let that one go. Albert writes from Cupertino, California. Isn't that one of your favorite places, Cupertino?
I've never been there. I've always wanted to go see the big giant spaceship that landed there many years ago and brought us the lovely things that are Apple products.
I think I'm going to be visiting right next door to there soon. Right?
Oh, because your daughter's going to college down there.
So I can go check it out.
You gonna go check out the spaceship? A friend of mine went to the spaceship. He's an Apple employee, and they brought me this lovely retro Apple pen.
Wow.
See, it has the little Apple logo on it.
And nobody is more Apple-y than Don McDonald.
I wouldn't say nobody, but
not very many.
Not many.
No, you were early. You've been continued, and you get every new thing that comes out within 15 minutes of leaving the factory floor.
Although I have to tell you, this is a sad day for me. This was a sad day, like 2 days ago, 3 days ago. Yep. Sad day. We have always watched television through the Apple TV device connected to our big screen TV, currently the Sony OLED, the Bravia. And I love the Apple TV. Love it, love it, love it, love it, love it. The one I have, I think, came out in 2021. So it's in tech years, it's like 100.
Getting kind of old.
Yeah, well, it got kind of old and it died.
So no TV now for the summer?
No. Here's the thing. I'm thinking. I know that Apple is going to be bringing out a new Apple TV in 2026. I know it's coming. The only problem has been Siri. It's coming. So my dilemma is, do I wait?
I think here's a suggestion.
Or do I spend $129 to get a new one and then suffer with the Google TV, which I just abhor, that Sony contracted for?
Maybe here's an idea.
What?
I'll be down there in September.
Yeah.
I'll steal one for you. I'll go run by, grab one.
Right. Okay.
Probably
My
got 'em
friend will
sitting
go to
out.
jail for shoplifting. That'll be fun.
It's probably a $200 fine in California.
Can
Sorry.
we
We'll go to
video
jail
it so
for
that I can see you being arrested and put it up on YouTube for millions of views?
It won't. It'd be a $200 fine in California, probably something like that. They doubt.
Yeah, well,
they'd put you
I
in
think they've been cracking
jail.
down after all those invasions. Okay, enough of that. Do we have another question?
Cupertino, yeah. He says, "Thank you, Albert, for your question. You've made negative comments about cash and the bucket strategy in previous podcasts.
You just did in this edition. You made negative comments about cash.
I know, and I like cash as much as the next guy could use some. Actually.
Not as much as some other people in your family.
Why do you have to go there?
I don't know.
I just bought my World Cup tickets, and Don is so excited that he wants to share with you.
You said I was going to bring that up, and you brought it up. How much were they?
Because I'm going to the World Cup.
How much were they?
I'm not talking about it.
Come on, you brought it up.
One thing I would like to talk about the bucket strategy is
4 figures.
Bucket one, where you have enough safe money to cover future distributions. How many years of distribution, RMDs in my case, would you have in bucket number one? And what would you consider safe money? My IRA is 70% equity, 30% bonds, and cash. According to Fidelity, my allocation resembles a growth and income strategy. Doesn't sound like a growth and income strategy.
Well, it's growth with income. I don't care about Fidelity's
That's a
weird
silly
name for it.
50-year-old label.
It definitely is.
But the question really on the table is, how much should you have sort of set aside in what you call bucket one? Mm-hmm. To pay yourself, for how long a period should you have sort of cash? Yeah, I think a year is fine. Yeah,
I like a year. I think a year makes everything really easy. It makes your annual rebalancing easier. It sets you up. If you do this at a set time every year, like the end of the year, and you put it away for the next year, it gives you a budget from which to work. Now, that doesn't mean that you might not deviate from the budget, either direction.
You're going back to the tickets again. I can see that.
Yeah,
okay.
and that you'll buy World Cup tickets that definitely cost 4 figures each.
I can't wait to see the beer price.
Well, when you pay 4 figures for a ticket, 3-figure beer looks actually pretty decent.
Maybe you should drink more of it. It'll make you feel about it less.
$102 glasses of beer.
God.
But they're European, so they're really big.
I use my dinars I've got sitting in the back. So, or dinar. Anyway, euros.
Diners.
The point is, back
Can
to the
you
negative
spend your
thing about
dinars
cash.
at the diner?
The reason I don't like cash is over the long haul, not currently. Currently, it's still, as Don just pointed out, you're still making 4%. Wonderful. How long that lasts, I don't know. Looking back over a long period of time, it's been what we call a drag on portfolio performance.
Having a lot of cash, yes, but you tend to get a little strident. I hate cash. Too much cash. You have too much cash in your portfolio.
Cash,
please
as we
remove
used to
the
say,
cash. It's not efficient, dude. If you have a year's worth of spending, that may amount to 5% of your portfolio.
Cash on the long haul is trash, so it's fine.
If it's in your mattress or in your Bank of America savings account at 0.03% of 1%.
No, I thought it was still 1. You looked it up last time.
Oh.
Then we look it up. Thank you, Bank of America. While you're out making 4% the easy way and paying me, can't even run the percentage. So small. So, that's just okay, Albert. Yeah, it's all right. 1 year, safe money. Don's right, finally. So, well done.
Don's right, finally? Oh.
I know. I have to say it.
Oh, wait, I know where I had it. I found it at bank rate, didn't I?
No, I don't remember how you got that number last time.
I think it was a bank rate. Or I could be just looking it up in my account. I mean, I have a Bank of America account, so it could have been
you know how much I have in savings at Bank of America? 0. I'm still getting like 3.7 at Marcus, I think, or something. So
I'm getting 4 at Bread. Ooh, CIT Bank is paying 4.1 right now. Apple Bank, speaking of Apple, it's not in any way, shape, or form related, is paying 4. And here we go. At the bottom, of the page is an ad. There's an ad for Chase, and there's an ad for Bank of America. APY, as of the date we recorded this at Chase, 0.01. At Bank of America, 0.01.
And here's the thing. This is the reason I'm hard on cash, is many of you are inefficient. You have money sitting around there. I bet there's trillions of dollars sitting in those type of accounts making nothing.
Why?
Sorry.
Here's the thing I don't understand.
That's why I get
Why
mad.
would you even bother moving money from your checking account to savings at Chase or Bank of America for those rates? Why would you even bother?
It feels good, Don. It's in savings.
At least I'm making a penny on every. Wait a minute. $1,000. Wait, is that a penny on
No.
Penny on
$1 million or something.
See, 1% of $100 is $1. No, that's 10. Yeah, that's 1% is $1.
Yeah, all right.
So it would be one penny
Ladies
on
and gentlemen,
$100.
next program we will come back and tell you how much you're making.
1 penny on $100.
Okay. Don't spend
And they
it all
don't even
in one
make
spot.
pennies. You have to wait 5 years on a $100 account, which is, by the way, what your minimum is at Bank of America. So you put $100 in, and they can't even pay you your income in cash. They can't do it because they don't make pennies anymore. You have to wait 5 years to get the nickel.
So good luck with the transfer. Oh. That's why I'm mad about cash. Okay, you wanted to know? That's why.
All right.
There you go.
Let's put it away, shall we? Let's end it. Let's kill this one off and try again another day. Thanks for listening. Questions? Go to talkingrealmoney.com. Click the contact form or the ask a question form. Want bigger help? Lots of help? You need an hour. You need a half hour with an advisor who's a fiduciary who we promise will not try to sell you anything and won't charge you anything either, which is really a great deal. Just go to talkingrealmoney.com. Click the button that says meet an advisor. You can even say, yeah, I don't want those kids. I want that old guy, Tom. I want to talk to the old guy, the really old guy, the oldest guy in the office.
Yeah,
you are the
true.
oldest guy in the office, aren't you?
Are you really going to go there?
You're the
Is
oldest
this
guy
really
in the
a
office.
place for you to be throwing stones right now?
No,
I don't
I'm
know.
not in the office. Okay,
Yeah,
that's
considering
the difference.
the birthday you've got coming up, I wouldn't
don't
think
care.
you'd want to raise
I am
age.
not in the office, so you're the oldest guy in the office.
I'm not the oldest guy in the organization. By the way, neither are you, I just found out.
Really? So
Yep.
there's somebody older?
I just learned this recently. Yeah.
Wow.
I know.
Not
and
by
guess
much,
what?
I'm
They're
sure.
still I don't know about that.
Okay. Anyway, we got to go now. Thanks for listening. Please tell your friends. Really, please tell people about the podcast, please. We're trying to catch up
While
with
there's
Stacking
still time.
Benjamins, and we're getting close. Yeah, well, there's still time for Tom. Because he's fading fast, folks. And there won't be much more of him talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.